3 days after James died, Carol used the debit card they had shared for 26 years. Size. The funeral home payment went through, but that did not prove the money legally belonged to her. Then the banker asked one question Carol could not answer. Curious. Does this account have rights of survivorship? Carol knew the account was joint. She did not know what the bank had recorded about ownership after death, and that one detail could decide whether Carol received the entire balance or whether part of the money belonged to James's estate. Pause. Here is the direct answer. Most joint bank accounts are held with rights of survivorship, which generally means the surviving owner receives the money. But not every joint account works that way. A tenants in common account can send the deceased owner's share to that person's heirs instead. So today, we are not asking whether two names appear on the statement. We are checking the 5 records that decide ownership, access, continuing payments, and deposit insurance protection after one joint owner dies. Near the end, I will give you the 6-step joint account survival test. It can expose the problem while both owners are still alive and able to correct it. Carol and James are hypothetical, but the rules in this video come from current federal guidance. State law, account contracts, and bank procedures can change the result in an individual case. Record number 5. The exact ownership title. Carol's statement showed both names. That looked like an answer, but it was only the beginning. The Consumer Financial Protection Bureau explains that most joint bank and credit union accounts are held with rights of survivorship. When one owner dies, the money generally passes to the surviving owner or to the remaining owners if more than 2 people own the account. But an account can also be held as tenants in common. In that arrangement, the deceased owner's share may pass under the will or state inheritance law instead of becoming the survivor's property. The difference may be recorded in the account agreement, signature card, or electronic ownership record. It may not be obvious from the monthly statement. Ask the institution this exact question. What ownership form is recorded on this account, and what happens to each owner's share when one owner dies? Request the answer in writing. Do not settle for, "It is a joint account." Now answer the comment question. Without checking your records, do you know whether your main joint account has survivorship rights, is held as tenants in common, or are you unsure? Write survivorship, tenants in common, or unsure in the comments. Carol eventually found survivorship language on an old signature card. That meant the balance generally passed to her. But another problem remained. A name on an account does not always mean the person is an owner. Record number 4. Owner, signer, agent, or trusted contact families often say someone is on the account. That phrase can hide 4 very different roles. A joint owner generally has an ownership interest and may have broad withdrawal authority while both owners are alive. An authorized signer may make transactions without owning the money. An agent under a power of attorney acts for the owner while that authority remains legally effective. Do not assume the authority continues after the owner dies. Confirm the result under the document and applicable state law. Some financial institutions may allow a customer to name a trusted or emergency contact. That person may receive alerts or be contacted when the institution suspects fraud or financial exploitation. But a trusted contact does not automatically own the funds or receive transaction authority. These roles can look similar at the teller window. They can produce completely different results after death. The FDIC distinguishes true co-owners from people who merely have signing authority. If Mary owns the funds and John only signs as her agent, the account may still be treated as Mary's single account for deposit insurance purposes. This matters far beyond insurance. Imagine James added his daughter Melissa so she could help pay bills during an illness. If the bank recorded Melissa as a joint owner with survivorship rights, the balance might pass to Melissa after James died, even if his will divided the estate equally among 3 children. If Melissa was only an authorized signer or agent, she might lose transaction authority at death and have no ownership claim. Same family, same bank, very different result. Use the role test. Is each named person an owner, signer, agent, beneficiary, or trusted contact, and what happens to that role when an owner dies? Do not add a helper as a joint owner until you understand the ownership and withdrawal rights you are creating. Carol was a true co-owner, but true ownership still did not tell her what the bank would do next. Record number 3. The bank's death notification process. A debit card can continue working while the bank's legal records are still being updated. That is why the transaction went through is not proof that the process is complete. Banks and credit unions can use different procedures based on the account agreement, state law, account type, institution policy, and whether anyone disputes ownership. The institution may request a certified death certificate. It may retitle the existing account, open a replacement account, update tax reporting, cancel a deceased owner's card, or review connected loans and automatic transfers. Carol first asked the bank, "Can I keep using the account?" The employee said yes. That answer was too broad. She needed 5 specific answers. First, what documents do you require? Second, will the account number change? Third, will checks, debit cards, online access, and bill payments continue? Fourth, will any funds be restricted during the review? And fifth, when will your records show me as the surviving owner? Write down the employee's name, the date, and the case number. If ownership is disputed, the balance is substantial, or the account is not a straightforward survivorship account, obtain qualified legal advice before moving large amounts. Do not empty the account because you fear it will freeze. A rush transfer can create a second dispute about estate property, creditors, taxes, or the source of the funds. Carol brought the death certificate, confirmed the survivorship designation, and received a written list of the next steps. At that point, ownership looked clear, but money was still entering and leaving the account, and one deposit arriving after death might not belong to the survivor at all. 3 records now matter. The ownership title decides who may receive the deceased owner's share. The legal role decides whether a person is an owner or only a helper, and the bank's procedure decides what must happen before the records are fully updated. The final 2 records control the money that keeps moving after death and the federal insurance protection that can quietly change months later. Record number 2. Deposits and withdrawals after death. A joint account can keep operating after one owner dies. Mortgage payments, utilities, insurance premiums, subscriptions, pensions, tax refunds, and government benefits may still appear. Some transactions should continue, some should stop, some should be redirected, and some require investigation before anyone spends the money. Social Security is a critical example. Notify Social Security as soon as possible when a beneficiary dies. In many cases, the funeral director reports the death, but the family should confirm that it was reported correctly. Because federal payments follow agency-specific rules, a deposit appearing after death may be due, returnable, or handled later as an underpayment. Do not assume the money belongs to the surviving joint owner. Do not spend it until the bank and Social Security confirm the payment status. Carol found a Social Security deposit scheduled after James's death. She did not move it to savings. She called the bank and Social Security first. Then she reviewed every automatic withdrawal from the previous 3 months. The home insurance premium needed to continue. A membership used only by James needed to be canceled. A medical payment needed investigation. Use 4 labels on every automatic transaction. Continue, cancel, redirect, investigate. Do not stop everything at once. Canceling a mortgage, homeowner's insurance, utility, or tax payment could damage the surviving household. The practical question is, what does this deposit or withdrawal pay for now, and who is legally entitled or obligated after the death? Carol had solved ownership and cash flow. Then the banker raised the most surprising issue in the entire review. Record number 1. The 6-month insurance change. Carol could legally receive the whole account and still have less federal insurance protection 6 months later. Imagine a qualifying 2-owner joint account containing $300,000 at one FDIC-insured bank. While both owners are alive, each co-owner's combined interest in all qualifying joint accounts at that bank is generally insured up to $250,000. That can provide up to $500,000 of joint account coverage for 2 qualifying co-owners. Now one owner dies. The FDIC generally continues to insure the deceased owner's accounts as though that person were still alive for 6 months, provided the account has not been restructured in a way that changes the coverage. This grace period gives the survivor time to review the deposits. After 6 months, coverage is calculated using the ownership that actually exists. If Carol becomes the sole owner, the joint account may move into her single account category. In this simplified example, assuming Carol has no other single accounts at that bank, $50,000 could then be above the standard $250,000 single account limit. And if Carol already has other single accounts at the same bank, those balances are generally combined in the same ownership category. The legal inheritance did not change. The insurance calculation did. Federally insured credit unions use comparable ownership-based share insurance rules through the NCUA. This is not a reason to panic and move money the day someone dies. It is a reason to calculate coverage before the grace period expires. Use the FDIC Electronic Deposit Insurance Estimator for bank deposits, or the NCUA Share Insurance Estimator for federally insured credit union deposits. Include every account at the same institution. Do not assume each account receives a separate limit. Coverage is calculated by depositor, insured institution, and ownership category. Also remember that a co-owned account naming payable on death beneficiaries may be insured under a trust category rather than the ordinary joint account category. When the structure is complex or the amount is large, verify the result directly with the institution or the appropriate federal insurer. The final question is not only, can I access the money? It is also, how is this money titled and insured after the death? The Joint Account Survival Test. You can perform this review before a crisis. Take the current statement, account agreement, and beneficiary information for every joint bank or credit union account. Then complete 6 steps. Step 1. Confirm the ownership form. Ask whether the account has rights of survivorship, is held as tenants in common by the entirety or under another ownership form. Get the answer in writing. Step 2. Confirm every person's role. Identify each owner, signer, agent, trusted contact, and payable on death beneficiary. Ask what each person can do now and what happens to that authority or ownership after death. Step 3. Request the death procedure. Ask which documents the institution requires, whether the account number changes, and what happens to cards, checks, online access, bill payments, and direct deposits. Step 4. Map the money flow review. 3 months of deposits and withdrawals. Mark each item Continue, Cancel, Redirect, or Investigate. Step 5. Calculate insurance before and after death. Use the FDIC or NCUA estimator and include all deposits at the same institution. Ask what the coverage would be while both owners are alive during the 6-month grace period and afterward. Step 6. Compare the account with the estate plan. Check whether the account result matches the will, trust, beneficiary designations, debts, and family expectations. If one document sends the money to Carol, while another assumes it goes to the children, you have a document collision. Correct it while the owners are alive and able to sign. Finish the review with one sentence. If one owner dies first, this account will pass to this person or estate under this ownership rule, and the institution will require these steps. If you cannot complete that sentence, the account is not fully understood. What Carol finally learned. Carol thought a joint account created certainty. It created shared access while both owners were alive. Certainty came only after she confirmed the ownership title, her legal role, the bank's procedure, the continuing transactions, and the future insurance coverage. For many married couples, a joint account with survivorship rights works exactly as intended. For other families, the same structure can create an unintended inheritance, give a helper more authority than expected, or conflict with an estate plan. The account is not automatically good or bad. It is either aligned with the family's intention or it is not. Ask your bank one question. What exact ownership form is recorded on our joint account, and what happens when one owner dies? Do not wait for the death certificate and the first disputed withdrawal to discover the answer. Subscribe to Grant Wexford for clear guidance on retirement banking, Social Security, Medicare, beneficiaries, and estate planning.